So we are discussing the chapter options in derivatives where we completed two segments, namely basics in options and number two option strategies. Please settle down, stop talking. Stop talking. Today we'll be discussing the following concepts. Number one, concept of continuous compounding, a time value of money concept only. So how to do continuous compounding and continuous discounting. From now onwards, all derivative instruments, the cash flows will be compounded or discounted using this technique called as continuous compounding or continuous discounting. Very important, that is going to be the first discussion today. Next discussion is theoretical boundaries for option value, namely maximum value and minimum values for a call option and put option. If it breaches the boundary, that is below minimum, above maximum, how to make arbitrage profit out of it will be the second discussion that is going to be made, theoretical maximum and minimum values of options. The third discussion will have an introduction today to the concept called as put call parity equation. Okay, these are all the issues we'll try to cover in today's class. Next class we'll continue with the put call parity and then also start discussing option valuation models. Really, the technical part of the chapter starts from now only. We're going to start discussing about valuation of options. So the real issues are the chapter starts only from this today's class. All the previous classes, option strategies are what they do in market to make some cash flow patterns and basics in option to understand the transactions. Okay, now let us summarize what has been discussed in the option chapter till now before we continue discussing the continuous compounding concept first. We saw that option is a contract. This option contract gives the holder a right and the writer gives the right to the holder. It can be either right to buy or right to sell. Right to buy option is called as call option. Right to sell option is called as put option. The right to buy or sell is on an asset, which is called as underlying asset, at an agreed price called as strike price, on a particular date called as maturity of the options. And for getting this right, the holder pays the premium and the writer receives the premium. In other words, holder is the buyer of the option, writer is the seller of the option. The price for the option is premium. Next, the holder only decides. The call option holder will exercise call option when the future spot price is more than the strike price, and the put option holder will exercise the put option when the future spot price is less than strike price. When the option is exercisable, it is said to be in the money. When the option is lapsed, it is said to be out of money. Indifferent said to be at the money. The options can be classified into two types, European, American options. European option, the holder gets a right to purchase or sell only on the maturity date. American option can be exercised anytime before the maturity date. Then we saw that the option, whether you get the value out of it or not, depends on the FSP. Now we saw what is break-even future spot price. Break-even FSP is the FSP at which the payoff for the holder and writer is zero. Break-even FSP is equal to strike price plus premium for the call option, strike price minus premium for the put option. And then we discuss about the option strategies. Straddle, strangle and spreads. Long straddle is where you hold a call, hold a put on the same underlying asset for the same strike price for the same maturity period. The payoff will be looking like a V for a long straddle. Short straddle is you write a call option, you write a put option for the same strike price, same maturity period and on same underlying asset. The cash flows will look like a A. Next, triangle, where you hold a call option, you hold a put option. Call is having a high strike price, put is having a low strike price, and it is on the same underlying asset, same maturity, is called as triangle. When you hold it, it is called as long triangle. The diagram would look like a tub. Okay. Short triangle, we are going to write a call option, write a put option with a high strike price for call, low strike price for put, with the same maturity period, same underlying asset is called as short triangle. The diagram would look like a inverted tub. Next, we discuss about spread. Spread is a case where you take a position of holder and then writer. So spread can be of two types: bull spread, bear spread. Bull spread, you hold an option with the low strike price, you write an option with the high strike price. And bear spread is we hold with the high strike price and write with the low strike price. So this spreads can be created on call as well as put options. So we have bull spread with call, bull spread with put, bear spread with call, and bear spread with put. Bull spread will be looking like a snake. The snake is going to look right hand side. Yes or no? Bear spread also will look like what? Snake. The snake will look what? Left hand side. That is, at higher FSPs, you make profit in bull spread. At lower FSPs, you make a profit in bear spread. We also discuss about butterfly spread, where we have 4 call options. One with the low strike price, one with the high strike price, 2 with the middle strike price. Hold with the low strike price, hold with the high strike price, right with 2 middle strike prices. That is going to be called as butterfly spread with call option. Same way one can create butterfly spread with put options also. Okay, these are all the issues we had discussed. In all this, nothing great discussed. Various cash flow patterns has been done. That's all, and very simple and easy area. Just to once again remind you, we are discussing about derivatives. How we can buy and sell at TCS shares. We can buy and sell what? On options on TCS shares also. You go to the stock exchange. Anybody has visited and seen a? Have you went to the port, the website and seen or not? No. Today also you can go and see just for an idea how the option prices are quoted. Okay. Nobody will charge you anything. Free entry only. Only when you buy and sell, you have to pay what? Charges. Watching not a charge. Can you proceed? No, please. Shh. Net charge, okay. So what you can do is, you can do some savings in Facebook and then go to NSC and see, okay, now that's better. Yeah, answer, net charge, okay. Yeah. Please. So, we say that how we can buy a TCS share, sell a TCS share. We go to the share segment, we will be having a buy, sell, that is button to be clicked. If you click the buy button, we are buying a share. Sell button means what? Selling a share. Like that, options, if you go to the option segment, TCS option, they'll give the contract details. You'll be having 2. Either click a buy or what? Click a sell. If you click a buy, you're buying an option. For that, you're going to pay what? Premium. You're said to be now holder of the option. You click a sell button, you are selling an option. You're going to receive the premium. You become a writer of an option. I also said that option contract may be delivered, may not be delivered. Delivery is not what compulsory. Even by netting off, one can close the contract. Everybody, are you following or not? Now, are all the issues we have discussed now in this area, options. Can I proceed? Now, just a small deviation. We'll have a small time value of money discussion, very necessary, and then come back to the chapter, options. Okay, now, concept of continuous compounding. Give that name, concept of continuous compounding. Concept of continuous compounding. Example. Mr. X deposited, example, Mr. X deposited rupees 1 lakh. Mr. X deposited rupees 1 lakh at 12% interest. Rupees 1 lakh at 12% interest for 1 year. At 12% interest for 1 year. What will be the maturity value what will be the maturity value? What will be the maturity value if the interest is compounded? What will be the maturity value if the interest is compounded? If the interest is compounded, A, point A, annually, the interest is compounded, A, annually, B, semi-annually, that is half yearly, B is half yearly, semi-annually, half yearly, both are same. Okay, A annually, B is what? Semi-annually or half yearly. C, quarterly, C is quarterly, D, monthly, D is monthly, daily utri, okay, D monthly, and E continuously. E is daily, to the power 365 should multiply, I'll never tell the answer also, okay. So E is what? Continuously. What is possible, let us do, okay, now. So it is annually, half yearly, quarterly, monthly, and then continuously. Next is what? Continuously. Okay, can we start or not? No. See. How much is the money deposited? 1 lakh. 1 lakh is the value today. It is called as what? Present value. They ask you to calculate the future value or maturity value. Respond. Can I start or not? No. Let's do it together. First, we all know the formula. Future value is equal to what? Present value into 1 plus r power n. Let us do it together. Future value is equal to present value into 1 plus r power n. Future value is equal to present value into 1 plus r power n. Can I start or not? Now, one by one. The first question is what? Annually. First is annually. Now, tell me, future value is equal to how much I deposited today? 1 lakh. And what is interest rate? 1.12. 12% na 1 lakh into 1.12 power. N is how many years? 1 year. So N is 1 year. 1 lakh into 1.12 power 1. Respond is or no? How much I got? 1 lakh 12,000. The amount maturing is 1 lakh 12,000 because the bank returns back my principal as well as what? 12,000 interest for 1 year. It gives you 1 lakh 12,000. Can I proceed or not? No. Things may be known to you. Once again, have a focus and listen. We are going to build up on this. Can I proceed? Next. Number 2. Second is what? Half yearly. Second is half yearly. Now, already in bond we discussed that we have to convert everything into per period. Everything into what? Per period. Tell me, half yearly, 12% is the interest for 1 year. What if I every 6 months? 6%. Okay, now write down future value is equal to what is amount deposited today? 1 lakh into R is 12% or 6% or 6% into 1.06. I said always convert everything into periods. N is number of years, number of periods, number of periods. How many periods here? 2 periods. In a year there are 2 6 months or not? 2 periods. I think you are all able to understand it clearly. Everybody yes or no? No. Tell me what is the number I am going to get? 1 lakh 360. Yeah? 1 lakh 12,360. 1 lakh 12,360. I have a doubt. In first case and second case, did amount deposited change? No. We deposited the same amount. Is the period of deposit different? No. Both we deposited for 1 year. Is the rate of interest given by the bank same or different? Same. Both cases the rate is how much? 12%. In my son, no. Rate also same. Amount also the same deposited. Period also what? Same. Why the maturity value differs? Frequency of compounding changes. When I compound more frequently, bigger the maturity value I am getting. Yes or no? Tell me. Why this is extra 360? Here, they provide interest only once. Now I earn interest what? 2 times. For example, after 6 months, I'll be getting a 6,000 interest. Yes or no? That 6,000 interest can be reinvested for another 6%. That becomes what? 360 extra. I think you're all following or not? No. So more frequently we compound. That means what? The cash flows are received earlier. The interests are received earlier. We just got a scope for reinvestment. That's what I will follow what I'm saying. So more frequently compound. Very frequently we are reinvesting money, and more will be the maturity value. This concept already discussed. Now I have the clarity or not? Can I proceed further? Now let's continue. The third question is what? Quarterly. Third question is quarterly. Future value is equal to what is the amount deposited? 1 lakh into 12% is the interest for 1 year. What is the interest for every quarter? 3 months here? 1.03. 3% now 1.03. However, how many quarters are in a year? 4 quarters. Okay. 1 lakh into 1.03 power 4. 1 lakh into 1.03 power 4. Tell me the number here. 1 lakh 12,000. 5. 1,12,551. The calculation is 1,12,551. See, the maturity value increases further when I compound more frequently. Yes or no? Now, one last calculation. The last question is what? Monthly. Monthly. Future value is equal to present value is what? 1 lakh. 12% is for 1 year. Every period is 1 month. How much percent per month? 1%. Into what? 1.01 power. What is that is 12. What is 1 lakh into 1.01 power 12? Gives how much going to be? 683. 1 lakh 12,683. Please. Monthly compounding is, please don't talk. Please. Monthly compounding is 1,12,683. 1,12,683 is the monthly compounding. Now, everybody tell me, as I compound more frequently, I am going to earn what? More maturity value, because the interest is credited here on annual basis. Interest is credited to my account on what? Half yearly basis. I get the interest on quarterly basis. I get the interest on monthly. How frequently the interest is credited to my account is what we call as the frequency of compounding. Up to this, are you following or not? No. Like that. If you look at the overdraft accounts and all, like credit, it can also be what? Debit. The interest are debited or credited on daily basis. Yes or no? The cash credit, OD account and all, if you see in bank audits, it will be what? Done on the daily basis. So that the interest is done what? On daily basis, the compounding is done or the discounting is done. Everybody following or not? No. So how we can have the frequency of compounding annually, every year interest credited, every 6 months the interest gets credited, every 3 months, every month, every day interest can get what? Credited. Like that interest can get credited every minute, yes or no? Every hour, every minute. It can also be what? Every second. Can be credited or not? Not every second, every microsecond, yes or no? Can be credited what? Every nanosecond. No. So if I credit interest, I don't say, I don't want to add a time. It is what? Continuously. Okay. Before I talk, 100 times interest would have been what? Credited. That's credited what? Continuously. Infinitely small unit of time, the interest gets what? Credited. Then such a compounding, we call as what? The continuous compounding. So continuous compounding means the frequency of compounding is not a year. The frequency of compounding is not a half year, is not quarterly, is not monthly, it is not even what? Daily, not even hourly, not even what? Minutes, not even seconds. It is going to be what? Continuously. We call as what? The continuous compounding. Respond yes or no. That is, it is a limit tending to infinity. Then we have seen the chapter called as limits. So in mathematics, limits. Okay. Whenever the limits tends to what? Infinity, we go for the exponential distribution. That is what we call here as E-compounding or E-discounting. No, I don't want to go deep into mathematics here. Just we have to see that. You may ask why E will be used. Always the exponential is used where it is continuous. It is a continuous series tending to what? Infinity. Then we can just go for what? The E-compounding or E-discounting. Can I put or not? No. How to do the continuous compounding is the last issue. Can I put or not? No. This I will do it and then give you time to copy it. We will do 2 or 3 more exercises for us to get what? Used to the continuous compounding as well as continuous discounting. Once we are thorough only, I will be able to proceed to the next stage. Don't undermine this, because every problem we are going to use only what? Continuous compounding and discounting, whether it is futures, options, as well as what? Swaps. All these chapters I will be using only the continuous compounding or continuous discounting. At that time, I cannot teach you this again and again. I have to discuss those advanced issues. I don't know. So I want to settle it once for all, now itself. Only when you certify that we have understood, we can just go for the next stage with clarity. Can I start or not? Now, I'll do 3 or 4 exercises for you to get a grip before you go for the next stage. Can I proceed? Now, interest is compounded. I think it is 5 here. Point number 5 here. Interest is compounded continuously. Okay, please. Shh. Now, I want the class to have a settled look. I don't want any person to talk. Okay. Any doubt you can ask me. Can I proceed or not? Now, see. Earlier we said future value is equal to present value into 1 plus r power n. Yes or no? Now, that formula now changes. Future value is equal to present value into that 1 plus r power n. Earlier we had as called as compounding factor. Now, instead of 1 plus r power n, you write future value is equal to present value into e power tr. Future value is equal to what? Present value into e power tr is the formula for doing the continuous compounding. Please, nobody write, just participate. So, future value is equal to present value into e power tr, where t is the term for deposit. T is always expressed in years. Is always expressed in what? Years. And R is a rate of interest. It is going to be always expressed as per annum. If R is expressed as per annum, T should be in what? Years. If you want to do R as what? Per month, then T should be in what? Months, obviously. But all of us will be using R in what? Per annum, and T will be in what? Years. Suppose I want to deposit 12%, that is money at 12% for 6 months. At 12% for what? 6 months. 12% is what? R. How I rate 6 months area? 0.5 years or 6 by 12 years. Everybody yes or no? Understand that T should be expressed always in years. I want deposit for 3 months. How I write here? 3 by 12. I write as what? 3 by 12. So R is annual interest and T is what? The term of deposit. The term of deposit should not be expressed in days, months and all. Should be expressed in what? Years. Everybody following or not? Now, let's continue further. Tell me. Future value is equal to, what is present value? 1 lakh into e power. I am depositing for how many years? 1 year. Understand that in all the examples, I am depositing only for what? 1 year. Same way, I am depositing for 1 year. At what percent or interest rate? 0.12. I am depositing for 1 year at 0.12. E power 1 into 0.12. If I just want to simplify, it is 1 lakh into e power 0.12. 1 lakh into what? E power 0.12. If I multiply this, I'll be getting what? The value. Everybody yes or no? Now, up to this formula following up. Now, how to calculate e power 0.12 is the next issue. But before that, are you following up? Now, tell me normally what is the compound interest formula? Future value is equal to present value into 1 plus r power n. As long as you don't compound continuously, you compound annually, half yearly, etc. If you want to compound what? Continuously, can tell me the formula for this? Future value is equal to present value into e power tr, where R is the rate of interest per annum and T is expressed always in years. If I deposit for 1 month, how will I express here? 1 by 12 years I express. Yes or no? No. In this problem, depositing for how many years? 1 year. So 1 lakh deposited for 1 year at what percent? 12%. So 1 lakh into e power 0.12 will be the answer for this particular problem. Everybody yes or no? No. The question is, how to find out e power 0.12? Question arises now. Now, I'll leave a line to complete this. So, e raised to something, e raised to x, e power x, how to calculate is nothing but 1 plus, it is 1 plus x power 1 by 1 factorial plus x squared by 2 factorial plus x cubed by 3 factorial it keeps on going. It keeps on what? Going. Now, up to 3 factorial, a high level accuracy can be obtained. Some books even stop at what? 2 factorial, not an issue. We can go up to what? 3 factorial. Can I proceed? 4 factorial, you can just go up to what? Infinity, continuous, na? But the decimals will be in what? 6th decimals or 7th decimals. I don't want such an accuracy. So you can stop with what? S cube by 3 factorial. Can I proceed or not? No. Please tell me, what is 3 factorial? 3 into 2 into 1. What is 2 factorial? 2 into 1. What is 1 factorial? 1. It is very simple. 1 plus x power 1 by 1 plus x squared by 2 plus x cube by 6. That gives you the calculation automatically, but this is the way to present it. Are you following what I'm saying? Is a continuous compounding formula. Can I proceed or not? Now, I want to find out e power what? 0.12. What is e power 0.12? 1 plus 0.12 by 1 plus what? 0.12 squared by 2 plus what? 0.12 cube divided by 6. Ennappa, right or not? No. Everybody fully having an understanding or not? No. 3 factorial is 3 into 2 into 1, 6. 2 factorial is 2. And 1 factorial is 1. It keeps on going. This level of accuracy is enough. Can I proceed or not? No. Most of them start with the 2 itself. Can I proceed? No. Please, can you tell me the simplified number? 1.12 1.127 5 or 4? Okay, let's check number 1.12748. Let us have it for your say. Understanding 1.12748 is a compounding factor. Respond yes or no. Now come to the future value. It is 1 lakh into what? 1.12748 is equal to how much of base here? 1,12,748. Now if I deposit annually, how much I get? 1,12,000. Half yearly, 1,12,360. Quarterly, 1,12,551. Monthly, 1,12,683. And continuously, 1,12,748. As a frequency increases, also what increases? The maturity value increases. Is the calculation of this particular part. Everybody yes or no? Now, see. What we can do is, examination generally gives you this factor also, but we will always do it. Okay, if they don't give it, you have to know how to do it or not. Now, so what is the factor 1.12748? You can just take the workbook. Please take the workbook. Last page, go to the workbook, last page, please. Have they given you the tables or not? Okay. See. This is a leg, that is table given. Natural log is an antithesis of exponential. We'll use this in Black-Scholes model later. You can just ignore that. E power x, e power minus x. One is compounding, another is discounting. We'll discuss discounting later. Now, you have to see in e power x. You have to see in what? E power x. Tell me what is the interest rate I want here? It is 12%. 0.12 na x power 0.12. 0.12 is here. Are you able to locate it or not? Now against 0.12, see what is the number? 1.12750. We wrote as what? 1.12748. Okay, that is almost same only. Can I proceed or not? Now, so this number only we learn how to calculate. How compounding factor is 1 plus r power n. Continuous compounding factor is e power tr is a continuously compounded factor. First of all, everybody, are you understanding it or not? Okay, now let us summarize, then proceed further. Tell me, what is a formula for continuous compounding? Future value is equal to, all of you, present value into e power tr, where t is a term of deposit or is a rate of interest per annum. So when the interest is per annum, the term of deposit also should be expressed in years. Okay, next. What is e raised to x calculation? How to calculate e power something, e power x here? 1 plus x power 1 by 1 factorial plus x squared by 2 factorial plus x cubed by 3 factorial. Yes or no? To put it much more simply, we can say 1 plus x power 1 by 1 plus x squared by 2 plus x cubed by 6. Enough. It goes. It is not stopping at 3 factory. It goes up to infinity. Yes or no? It is a continuous distribution. But still, we stop with what power 3 by 6 because that accuracy is more than sufficient for our calculations. If you go for some high scientific research and all, they may go for what more high level calculations where even a 15th or 16th decimal may be what important. For many matters, it is not so much important. It is enough if you have a 4 decimal accuracy or 5 decimals. Everybody, are you following or not? That's the one should do the e-compounding. Can I proceed? Now, copy this before you do 1 or 2 more exercises. Now, write down point number 5. Please copy this. Point number 5. Finish copying, huh? Those who not copy, please raise your hand. Please. Shall I proceed? Huh? Those who are not copied, please raise your hand. Can I proceed or not? No. So, now we have seen how to do the continuous compounding where the interest is credited continuously for the deposit period. Okay, now let us extend the question. Find maturity value. Please write. Find maturity value. Find maturity value using continuous compounding. Find maturity value using continuous compounding if find maturity value using continuous compounding if Mr. X deposits the above money, if Mr. X deposits the above money for, if Mr. X deposits the above money for, if Mr. X deposits the above money for A 3 years, A for 3 years, B for 3 months, A for 3 years and B for 3 months. So earlier he was depositing the 1 lakh for how many years? 1 year. Now we are saying how much will be the maturity value. We deposit for what? 3 years. And number 2 is what? 3 months. I don't want to do annual and all. That is everybody known to you, say known to us. I have to only the continuous I want to do. Can I proceed or not? Now. So now tell me, A is depositing first for how many years here? 3 years. Write down. 3 years. Get the heading. 3 years. Let's do it together. Let's do it together. This time we are going to do it together. Tell me the formula. Future value is equal to all of you. Present value into e power tr. Future value is equal to present value into e power tr, which is equal to, what is present value? 1 lakh deposited into e power. How many years? 3 years. What is rate of interest? 0.12. Please, 1 lakh into, we should do together. Don't create noise. Can I proceed? It is 1 lakh into e power 3 into 0.12. Can I simplify it? It is 1 lakh into, tell me what is that? E power 0.36. Now 0.12 into 3 gives you 0.36. 1 lakh into e power 0.36, which is 1 lakh into, I have to find out e power 0.36. Yes or no? Now, let's have a working note here. Let's have a working note. You have to find out what? E power 0.36. E power 0.36 is equal to, we know the formula. What is e raised to x? 1 plus, what is x? 0.36 by 1 factorial is what? 1 plus, next is what? 0.36 squared divided by what? 2 factorial is 2 plus 0.36 the whole cube divided by 6. 0.36 cube divided by 6 is how one should be doing the calculation. Everybody understanding it or not? Now, please tell me how to tell the number here. 1 plus 0.36 plus 0.36 squared by 2 plus 0.36 cube divided by 6. Tell me the number in at least 4 decimals here. 1.1%. 1.4326. 1.4326. Very simple. 1 rupee deposited today will become what? 1 rupee 43 paise approximately after how many years? 3 years. If I compound that 12%, how? Continuously. If I compound annually, the money will be what? Much more lesser. Okay, 1 lakh into 1.4326. 1 lakh into 1.4326 is equal to how much here? 1 lakh 43,260. 1,43,260. 143,260. This is a maturity value of 1 lakh after 3 years. If the money is what? Continuously compounded. I want everybody to respond. Are you following or not? Now, next. Next is what question here? 3 months. Next is what question? 3 months. Next is 3 months. Future value is equal to formula present value into e power tr. I think you are all doing along with me or not? Present value into e power tr. Anybody, if you have a difficulty, stop now itself and ask me. I think you are all following on. Anybody requiring any, once again, any repetition, or can I proceed? No problem. Answer. Repetition or proceed? Okay. Now, which is equal to, what is present value? 1 lakh into e power t is how many years? 3 months means how many years here? 3 by 12 years. In my son, 3 months means what? 3 by 12 years or not? Correct? 3 by 12 years into what is rate of interest? 0.12. E power 3 by 12 years into 0.12. Then it is 1 lakh into e power is going to be what? 0.03. 3 by 12 into 0.12 gives you what? 0.03. 1 lakh into e power 0.03. I hope everybody understanding it or not? Now, so I should find out now 1 lakh into what is e power 0.03 we should calculate, right or not? Now, right, working note. What is the working note? E power 0.03 is equal to, tell me the calculation, 1 plus, I want to hear everybody, 1 plus what? 0.03 power 1 by 1. Please, next is what? 0.03 square divided by 2 plus what? 0.03 cube divided by 6 plus 0.03 cube divided by 6. Can you simplify and tell me what's the number here? 1.03045. 1.03045. 3% by hearted because number awesomes will be using this 3%. Okay. 1.03045. 1 lakh into 1.03045 is equal to how much here? 1,03,045. 1,03,045. 1,03,045. Just for you to have a clarity, go to the last page. I have found out for what person? 03. E power 03. I have to find out or not? Please look at the workbook and tell me what is e power 0.03 calculation. 0.03 gives you 1.03045. Exactly, we calculated. Respond yes or no. That's how the table values have been obtained. Now, examination will generally give you the compounded factor. You need not calculate. If they don't give it, also we should know able to calculate it. That's why we are just doing the calculation part. Enough, right or not? Now, so tell me, what is 1,03,045 maturity value, or how much deposit today? 1 lakh. For how many months? 3 months. At what percent? 12%. Compounded continuously. A maturity value does not depend only on the principal interest term. It also depends on frequency of compounding. All derivative instruments are going to be compounded or discounted what? Continuously. Enough, right or not? Now. This is point number 1. Can I go to the next stage of discussion or not? Now, see. If they give you maturity, we should find out the present value or not. Okay, now, what is present value generally? Look at this. What is present value? Present value is equal to future value into 1 by 1 plus r power n. Ennappa, right or not? Yes or no? Now. Rearrange, yeah? Future value into what? 1 by 1 plus r power n is equal to what? Present value. That 1 by 1 plus r power 1 only we call as what? Present value factor. Right or not? So present value is equal to future value into 1 by 1 plus r power n for normal compounding. Right or not? Now, for continuous compounding, nothing right here. Present value is equal to future value into 1 by e power tr. If future value into what? 1 by e power tr. Calculate e power tr normally, and then what? 1 by e power tr gives you what? The present value. Right or not? So now, again I write present value is equal to, please, no need to copy. Present value is equal to what? Future value into 1 by e power tr. How books and all present is future value into e power minus tr, because 1 by x is nothing but what? X power minus 1. Like that. So 1 by e power tr can be written as what? E power minus tr. A number raised to minus power is nothing but what? Inverse. That's the meaning. X power minus 2 is what? 1 by x square. Like that, you say 1 by e power tr as what? E power minus tr is a calculation part. Right or not? Now, that's how one should calculate the present value. Can you proceed or not? Right now, next. Continuous discounting. Write down continuous discounting. Continuous discounting. Continuous discounting. Mr. X requires a maturity value of 1 lakh. Mr. X requires maturity value of 1 lakh after 1 year. Mr. X requires maturity value of 1 lakh after 1 year. How much should he deposit today? How much should he deposit today if interest is 12% per annum? How much should he deposit today if interest is 12% per annum? If interest is 12% per annum compounded continuously. If the interest is 12% per annum compounded continuously. If the interest is 12% per annum compounded continuously. Everybody understood or not? Now, can do the calculation. Now, they ask you to find out how much should be deposited today. You have to find out future value, present value, present value. Write down solution. Let's do it together. present value is equal to, please write, present value is equal to future value into 1 by e power tr. Present value is equal to future value into 1 by e power tr. But always don't write 1 by e power tr, write as what? Present future value into e power minus tr. That's so all books represent the discounting. Is future value into e power minus tr. Can I proceed further or not? Now, let us substitute the numbers. Present value is equal to, what is future value? How much I want maturity amount? 1 lakh. I want a maturity of 1 lakh into e power minus, what is t? How many years? 1 year into r is what? 0.12. 1 lakh into e power minus 0.12. Simplify it. It is what? 1 lakh into e power minus 0.12. 1 lakh into e power minus 0.12. 1 lakh into e power minus 0.12. Everybody understood or not? No. So don't ask me how to find out e power minus 0.12. Find out what? E power 0.12 and then inverse it. Enna right or not? No. Write down working note. Working note. E power 0.12. You might have already done it, but still do it once again just for clarity. Okay. Don't look at the previous page. Turn to that page. Can you proceed? No. Tell me first. 1 plus, what is x power 1? 0.12 by 1 by 1 factorial. Plus what? X squared is what? 0.12 squared by 2 plus what? 0.12 cube divided by 6. No. Class is very silent and some disturbance is there. That is why I am having a doubt. Everybody understanding and writing it or not? No. Please. Shh. Tell me the number here. What is the number? 1.1275. Okay. What number here? Okay, 1.1275, write it, table 1.1275 is 1.1275, please. 1.1275. Now, I don't want e power 0.12, I want what? E power minus 0.12. Continue writing, e power minus 0.12 is equal to 1 by 1.1275. Innappa, correctappa? 1 by 1.1275. What is the number? 1% point? 88692, some number, 0.88692, please, 0.88692. Romba simple. What is 0.88692? Present value factor. What is the there? Present value factor. 1 rupee after 1 year is worth how much? 88 paise today. If I say discount what? Continuously. That's all. We had not 10% present value factor. 1 year is 0.9091. That is the present value factor for annual discounting. We can have what? Something different than 0.909. If you go for what? A continuous discounting. That's all. There is nothing but what? Present value factor. Innappa, right or not? Are you following or not? Now, so what is discounted? This is called as discounted cash flow is what? Cash flow into present value factor. That's how one should calculate P factor for what? Continuous discounting. Enna right? Now, so write down. It is 1 lakh into, the answer, it is 1 lakh into, what is the number? 0.88692. 0.88692. Is it how much here? 88,692. 88,692. Can you tell me the meaning of this 88,692? Today, if I deposit 88,692, after 1 year matures to what? 1 lakh. If the bank offers 12% interest rate compounded continuously, if I compound this annually, I will not be getting a number. Is on what I am saying? I should be able to compound continuously. Is a meaning. Respond. Is or no? Now, ரொம்ப simple. Tell me, what is present, say, discounted cash flow? Normally we discussed what discounted cash flow. Cash flow into present value factor. A cash flow, the future value. Present value factor is what? E power minus TR. That's a only small change. Instead of 1 by 1 plus R power n, I use what? E power minus TR for discounting. So let us do one more exercise problem before I go for the next stage. Okay, please. Shh. Write down. If Mr. X requires 1 lakh after 3 years, if Mr. X requires 1 lakh after 3 years, how much should he deposit today? If Mr. X requires 1 lakh after 3 years, how much should he deposit today? And after 3 months, another question, and after 3 months, how much should I deposit today? And after 3 months, how much should I deposit today? Two questions here. This is one. After 3 years, how much should I deposit today? After 3 months, how much should I deposit today? And if Mr. X requires what I dictated, if Mr. X requires 1 lakh after 3 years, how much he deposit today? And after 3 months, other first sentence is common, 1 lakh after 3 months, how much you deposit today? Obviously the interest is what? Compounded continuously. Can you start doing it or not? No. Before that, never? What is it? Are they same sum? Okay, interest 12%. Yeah. Interest rate is 12%. Interest 12%. Interest 12%. Continuously compounded. Interest 12% continuously compounded. Before that, in the last problem, 12% interest. Now, last sum we did not 12% interest. E power minus x, a column given no. What is 12% e power minus x? 0.88692. The same number we got. Everybody yes or no? That's called as, these are all the future value factor. These are all what? Present value factor. That's one simple example. 10% C, 0.10. What is P factor for 0.10? No, say 10. 0.90484. Normally it has what? 0.90? 9091. Yeah, 0.9091. No, it becomes what? 0.90484. Much more lesser because of what? Continuous. Everybody are you following or not? No. Can I proceed? Next. So let us do it for 3 years. Please write 3 years. Okay. Present value is equal to, please write the formula. Present value is equal to what? Future value into e power minus tr. Please. Present value is equal to future value into e power minus tr. Future value into e power minus tr. Can I proceed? Now, tell me. What is the future value? 1 lakh. I want 1 lakh. After 3 years into e power minus. What is t? 3 years. Into r is what? 0.12. 1 lakh into e power minus 3 into 0.12 is equal to, tell me the number, 1 lakh into e power minus 0.36. 1 lakh into e power minus 0.36. 1 lakh into e power minus 0.36. Everybody able to understand or not? Now, write the working note. E power 0.36 is equal to, we are going to do it together. E power 0.36 is equal to what? 1 plus 0.36 power 1 by 1 plus 0.36 squared by 2 plus 0.36 the whole cube divided by 6. 1 plus 0.36 power 1 by 1 plus 0.36 squared by 2 plus 0.36 cube divided by 6. Everybody understanding and writing or not? Now. Can I proceed? Okay. Tell me what is the number here? Per person here 1.43 1.4326 is equal to 1.4326. I want e power minus 0.36 is equal to, just a minute here, e power minus 0.36, do along with me, is equal to 1 by 1.4326. 1 by 1.4326. Tell me the number. 0.69. 0.6980. Okay, 0.69803. So the answer is 1 lakh into 0.69803 into 0.69803. Is it how much here? 69,803. If I deposit 69,803 today for 3 years at 12% continuously compounded, I will be getting how much maturity value? 1 lakh is the meaning. Respond yes or no? Please, yes or no? Next. Next. I think you are all doing along with me the answer up. Can you turn the page or not? Next. 3 months. The last calculation going to be 3 months. Please. 3 months. future value is equal to present value into future value is equal to present value into e power minus tr. Present value is equal to future value into accepted e power minus. Good morning. Yeah, sorry. Can I proceed? Now, continue further. Okay. Now, what is future value? 1 lakh into e power minus, how many years here? 3 by 12 years into r is what? 0.12. 3 by 12 years into 0.12. Now it is 1 lakh into e power minus 0.03. 1 lakh into e power minus 0.03. Working note. E power 0.03 is equal to e power 0.03 is equal to 1 plus 0.03 power 1 by 1 plus 0.03 squared by 2 plus 0.03 cube divided by 6. Please. Which is equal to 1.03045. 1.03045. Now, e power minus 0.03 is equal to 1 by 1.03045. What is the number here? 1% point? 97045 is equal to 1 lakh into 0.97045 is 97,045. 97,045. 97,045. Once again, to confirm our answer, please look at the last page. Look at 0.03 e power minus x. Please look at 0.03. That is e power minus. What is the number there? 0.97045. The same number you are getting. Everybody, are you understanding it or not? No. With this, we complete this particular small discussion on what? Continuous compounding and continuous discounting. Derivative instrument always uses continuous compounding and discounting for their calculation. Why? Don't ask me now. We'll discuss that in the later stages. Why should we use what? Continuous or compounding or discounting. But understand that from now onwards, the chapters to follow. Whenever I compound, whenever I what? Discount. I always use what? Continuous for compounding and discounting. That's a unique feature of the time value of money for derivative instruments. Everybody, can we start or not? Because still now when we did all the sums till the last class, we did not have any interest rates given. We ignored what? Time value of money. The payoff, when I calculate, the premium is paid or received today. The money is got what? Tomorrow. We netted off straight away. Yes or no? No. All this are wrong because of what? Time value of money. Now we'll really see how we are going to have the time value of money incorporated into the calculations. Okay. Now, this discussion, those who understood continuous compounding discounting thoroughly. Use the word what? Thoroughly. Raise your hand. No problem, na? Now. Later, don't look at me, stare at me. I'll have a heart attack because for example here, okay, because I cannot teach you this when discuss the option evaluation models because there's nothing more to be what? Discussed and not this again and again. Everybody following or not? That's why I spend lot of time now to make you thorough with what? Continuous compounding and discounting. So now let us go back to the chapter called as what? Options. This is not option chapter. This is what? Time value of money. Okay. So we'll go back to the chapter options now. Please. Shh. Please. Shh. Yes, Yafa. Now, shh. Please. See, in all the markets, what we do is, we value the asset, compare with the market price, and see whether it is overpriced or underpriced, and then decide to buy or sell. That's what I have been doing in the entire session. We discussed first about the bond market. First discuss about what? Bond market. We saw how we should value the bond on our own. We value on our own the bond value. Compare that with what? The market price of the bond. The bond may be overpriced, underpriced by the market. Suppose I feel that the bond is worth 800 rupees. In the market, it is trading at 900. What I will say? It is overpriced. The bond is what? Overpriced. I will not buy that bond. If I have a bond, I will be rather what? Selling it. Right or not? No. So similarly, suppose I find the value of the bond and the bond value I feel is 800. In the market, the same bond is available for 700. What I will say? Underpriced. I'll just go and buy that particular bond. Right or not? Same way, we calculate the share value. P0 is equal to D1 by KE minus G. One of the formula, yes or no? So we try to find out the value of the share on our own, and we compare our value with what? Market value. If the market value is more, it is what? Overpriced. I will not buy the share. If possible, short sell the share. Yes or no? And if I find that the share value in the market is very less, I'll go and buy the share. Always any asset, not only share, bond, any asset in the world, you try to find out your perception of the share's value or a bond value, etc. and then compare with what? The market. Okay. I don't mean to say you are right or the market is right, but there's always an opinion that market may be right. In an area called as efficient market, hypothesis. But forget that, you may also be what? Right. Market may not perceive how you perceive. Yes or no? So what you normally do, you just value on your own, compare with the market value, identify underpricing, overpricing, and decide to buy or sell the asset. Am I right or not? And every item valuation concept simple. What is the value of the bond? Present value of the future cash flows. What is the value of the share? Present value of the future cash flows. Like that we find the value. It is not share valuation. So many formulas are there. Namely the dividend discount model, Modigliani Miller approach for share valuation, Walter, Gordon, and now single holding period. So many models have been seen for share valuation. Not over. We have got one more chapter pending called as what? Equity valuation, where I discuss free cash flow models later. Everybody following not? But there are so many models for valuing what? Shares. Like that bond value, no models required. Simply discount the coupons and what? Redemption to get the value of the bond. Right? Are you all following what I am saying? No. Like that. How a share is having value, how a bond is having value, this option contract should have value or not? That is what we call as value of an option. We call as what? Value of an option, which we give the name premium. We give the name what? Premium. I call TCS share price. I call what? TCS share price. I call Reliance bond price. Okay. When it comes to option, they call as option pricing also. People call it. They also call it as what? Option value. Okay. So the option value or option pricing is nothing but we refer to premium. Whenever I say the value of call, I mean what? The premium of the call option. When I say value of the put, I call as what? The premium of the put option. Everybody, yes or no? Like any other asset, what is the value of an option? Value of an option is the present value of the future benefits. About the option valuation only, we are going to discuss in the next 3 classes or 4 classes. We are going to discuss about what? The option valuation. Around 12 hours we will be spending for what? Discussing these various concepts regarding the option valuation. From now onwards, we are discussing about one number called as what? Premium. Premium. That is what we call as price of the option or value of the option is something like what? The premium. What is the value of the share? Share price. What is the value of an option? The option premium, or we can also call as the option price. That is why they call as option pricing model or option premium models, etc. Everybody understood what I am saying now? Here, I just want to remove a doubt and then proceed, because most of the batches this doubt comes to say every time it comes. I'll just remove that before I start discussing the issues. See. Okay. I'll make you visualize and then go for the discussion. This was our question number 4, call option problem. Question number 4 what? Call option problem. Can you proceed now? Look at question number 4. Alla nyamam irukappa? Look at question number 4, please. Okay, please. Now, we are entering into very serious discussion areas. I want you to cooperate, be silent. Moreover, I want you to immediately get any clarification done now itself. Don't carry forward, okay? Because it becomes more and more complex as we go deep into what? The chapter, okay? Please. See, in question number 4, there is a call option with a strike price of what? 70. Strike price of what? 70. Premium 5 rupees. Leave that 5 rupees premium. Above that only the discussion is going to be made. Yes or no? No. I want you to look at only the first column and second column. FSP and what? Value of the call. Now, please. You purchased a call option. You purchase what? Call option. Or you are going to purchase a call option. Purchasing call means what? Holding a call. Yes or no? You are going to purchase a call option with a strike price. How much rupees? 70 rupees. And you believe that the FSPs may range from what to what? 50 to what? 90. Now, you see the way that is, shares if you buy a share, you get what? Future dividends. D1, D2, D3, D4 up to what? D infinity. You buy what? A bond. What do you get? Future coupons as well as what? The redemption. Like that, when you buy an option will not give you future cash flows, will give you what? Future cash flow. Because only once the cash flow is going to be had. Yes or no? Forget about mark-to-market procedure, that's a different issue. Now, when I buy an option, a 3 months call option when I buy, what happens here? On maturity date, I'll get a cash flow. And the beauty is, the cash flow which the holder will get will either be 0 or what? Positive, and never be negative for an option. Yes or no? Now, so what is the value of an option? Value of the option is the present value of the future cash flow. Yes or no? What is the future cash flow an option holder may get? He may get 0 or he may get what? FSB minus X. So he may either get what? Nothing from the option. If the option is what? Lapse. I am saying about call option. If he exercises, what he get? He will get what? He exercises what price? Strike price. The share what? FSP. He will either receive an amount FSP minus what? X as a cash flow, or he may also receive what? 0. If we receive 0, I say the call is worthless on the maturity date. We receive what? FSP minus X. The call is what? What that money on maturity date? Yes or no? Now, for example, say when he buys this call, what he may get? He says, I may get 0. If the share price is what? 50. I may get 0. The share price is what? 55. These are all not cash flows. These are all what? Possible cash flow. That's what I'm saying. In that case, he may get 0. 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 If the FSB is what? Below 70. Now. Or he may get what? 5. Or he may get what? 10. He may get what? 50. He may get what? 20. These are all the possible cash flows from the call option if he buys a call. Yes or no? Now, I use the word value of the call here. Don't confuse this. This value is the possible value on maturity date. Is what the possible value on maturity date. I don't buy a call to get 0. I buy a call to get what? Either 5, 10, 15 or 20. How I calculate today value? Leave it. Yeah. These are all the possible future value I get from the call. Yes or no? Now, value of the call is what? The word value means what? Benefit. Okay. So the value of the call, suppose is 5. What is the meaning of the 5? The call may give me a value of what? 5 or value of what? 10 or value of what? 15, value of what? 20. This is a future value of the call or not? If I discount it to today, I get what? The present value of the call. That's we call as premium. Yes or no? So, don't say, sir, what should be discounted? 5 or 10 or 15 or 20 or? It's a very difficult issue. We'll be having a lot of models to discuss that. That is why this chapter is very interesting compared to a share valuation or what? Others. Okay. Option value was a challenge for so many years for what? Persons wanting to find value. But understand that the overall framework is, I get the value from the call or not? I get some money from the call or not? If the call is in the money, if the call is what? In the money on the mature date, I'll be getting some possible cash flow or not? The present value of the possible cash flow only, I call as what? Value of the call today. I call as what? Value of the call today. That value of the call today only is a premium I will be willing to want to pay. Yes or no? How the present value of future dividends. So when I hold a share, I'll be getting what? Dividends. The present value of future dividends is the value of the share today or not. Like that, the present value of the future value is what? The value of the call today. And how that value of the call today should be fixed. So I have fixed a premium of 5 rupees or not. How the premium should be fixed only will be the subject matter of discussion throughout the next 3 or 4 classes. Everybody, are you following or not? So we are now discussing about only one number called as what? Premium. How to discover premium for an option is going to be the main issue, because success of an option depends on a right premium you fix for what? Paying or receiving the option. Yes or no? Okay, what everybody does is, they will try to find their own premium. That is, everybody will be having different perceptions, or no? So because we think about share prices differently, so the share value can be what? Different. Like that, you find your own premium. You find what? Your own premium. You value the option on your own. Suppose you feel that this call option, it is worth only paying 4 rupees premium. And what the premium trading in the market? Yeah, 5 rupees. Now you say the call is what? Overpriced. When you feel the call is overpriced, what you will do? Sell. You become a writer. Yes or no? If you feel that the call premium is what? 6, it is trading at how much rupees? 5 rupees. The call is trading at 5 rupees premium. I feel the call is worth how much rupees? Yeah, 6 rupees. You feel that the call is what? Underpriced. What portion you will do? Buy a call and become what? Holder of the call. So whether you're going to be a holder or writer depends on your perception whether the premium is what? Overpriced or underpriced, and take appropriate portion. Everybody, are you following what I am saying? This is a background of discussion about the premium. So many concepts are going to be discussed. Theoretical bounds, put call parity, premium valuation models like Black-Scholes, binomial, etc. All this will be discussing in the next few classes. Everybody, can we start or not? Now, first of all, don't get why I am discussing this is, son, at that time you wrote value of call. Now once again discussing what? Value of call. What is that value? What is this value? This is what value? Future value of the call. This is what call is future value of the call. This is uncertain. This is what? Uncertain. For the future value of the call, I pay a value today. I call as what? Present value of the call. That is what we call as the option premium. Everybody, yes or no? So now onwards, when I use the word value of the call, I always mean what? Premium. I always mean premium. The other word that can be used for the premium is price of the call option, value of the call option. Everything will be called as a premium. Can we start with the main discussion or not? Okay, now. See, I will now dictate a small table and formula. We can by heart it, and then we can start our discussion. Okay, now give the heading. Theoretical boundaries for call and put option values. Theoretical boundary for call and put option values. Theoretical boundaries for call and put option values. Theoretical boundaries for call and put option values. Okay, now please copy this slide quickly. PV means what? Okay. I am not disbelieving you, I am only confirming, that's all, okay. As I said, I am not disbelieving you, I am only confirming, okay. See, let us by heart it and then start our discussion, what is being done here, okay. See, call option, put option, I want to find out maximum value and then what? Minimum value. Okay, tell me, what is maximum value of a call option? I mean by heart or not? What is the maximum value of the call option? Spot price. The maximum value of a call option is spot price. Minimum value of a call option is spot price minus present value of strike price. This is the formula. So the maximum value of a call is spot price. The minimum value of the call is what? Spot price minus present value of strike price. Spot price of what? Yeah? Shares on which the call is written in the written order. So the spot price is the maximum value. Spot price minus PV of X is what? Minimum value. What is the maximum value of a put option? Present value of strike price. What is the minimum value of a put option? Present value of strike price minus spot price. Everybody having the clarity or not? Now, this is the first thing we have by heart at it. We are not yet discussed. Okay, now let's start our discussion. What is that is going to be discussed here? See, when I say value, I mean what? Premium. Always from now on, as the word value means what? Premium. For a call option, the premium should not be below some number. The premium should not be above what? Such number. Okay. Now I want to know within what boundary the premium should be there. Okay. Within this range only the premium should be there. The premium should not be below the minimum. It should not be what? Above the maximum. Point number one. Yes or no? The question is, sir, if it is below the minimum, above the maximum, what happens? Then arbitrage exists. Everybody follow what I am saying? Should I repeat that? I will repeat once again. See, I say, just a number, I say, this call option should not have a premium less than 5. It should not have a premium more than 25. Okay, that means I can say, in the market, if the call value is between 5 and 25, perfectly okay. It is 5 and 25, perfectly what? Okay. If the call is trading in the market at a premium between 5 and 25, it is perfectly okay. But in the market, if I see that this call is having a premium less than 5, trading at 4 rupees means immediately I can jump. Market is not properly pricing the call. I can jump into the market and make a riskless profit called as what? Arbitrage profit through a strategy. Everybody following or not? Similarly, if I see that this call option is trading in the market at a premium of 28 rupees or what? 29 rupees. The premium is more. It is what? Overpriced. The call is what? Overpriced. I can jump into the market and make what? Some arbitrage or riskless profit. So now we are saying that call option and put option values or premiums should be within a boundary. Should be what? Within a boundary. If the boundary is breached, what happens here? Arbitrage exists. Is a discussion that's going to be made. Response is or no. The boundary only are these formulas. A call option value should not be below what? Spot price minus present value, strike price. A call option value should not be above what? The spot price of the share. The put option value should not be below what? Present value of strike price minus spot price. The put option value should not be above what? Present value of the strike price. When I say call option value, put option value, nothing but what? Premium. A call premium should not be below spot price minus PV of X. A call premium should not be above spot price. A put premium should not be below PVX minus what? The spot price. Should not be above the present value of strike price. Is a discussion. Everybody yes or no? If it is going to be above or below that, what exists here? Arbitrage exists. Above that, we will be doing some problems. Everybody following on. Issue in that, mostly all textbook, including Hull, they'll do problems only for the minimum values. They do problem only for what? Minimum value. Maximum is very theoretical discussion. It will never happen in what? Market. Market always see whether the minimum is what? Breached or not for the arbiters to jump in. Maximum will never be breached. Even a fool will not go for the number below, say beyond the maximum. We'll see the reason later. So all problems in the textbooks and study material is only about what? Minimum value of a call and minimum value of a put. But I want to make the discussion complete. Hence we also discuss about what? The maximum boundary also. We'll be seeing the maximum value and maximum value of call and put option also. So can we start with our problems and solutions or not? Now, first of all, tell me what is that we are discussing about what? Premium. We are discussing about what premium? Boundaries for the premium. For a given option, the premium should be within the given range. If it is going to be above or below the range, what happens here? Then we are going to have an arbitrage opportunity. The range for call premium discussed, the range for put premium now has been given. So the word premium only, we know frequently use the word what? Value. From now onwards, when I use the word value, can I understand as premium or not? Because I cannot again repeat premium. Everybody uses the word what? Value only. From now onwards, the word value of the call means what? Premium of the call option. Value of the put means what? Premium of the put option. Can we start discussing or not? Now, let us start with the first. Take question number 17. Take question number 17. Take question number 17, please. Now it is 7:45. Got it? Now, today we should complete question number 17. I'll do an example problem for maximum value. Then question number 18 should be completed. And also we should be having an introduction to what? Put call parity. And possible try to complete question number 19. Then target will never go home or go to office without this target being achieved. Can you start or not? Now, let us start. Please. Importantly, very crucial phase, if you lose track of me in today's class, will never be able to catch up with me in the future classes. I am saying seriously, there's no second chance, okay? Everything what we discuss will be developed further, okay? All this discussion should be with utmost clarity. That is why, please, I have not yet started for past 20 minutes. What I am going to discuss only I am discussing. Because having not a confusion about what is being discussed. Are you following or not? No. Let us start with the problem number 17. Please. Given the following. Strike price 180. Current price of 1 share 200. Risk-free rate of interest 10%. Calculate theoretical minimum price of European call option expiring after 1 year. If the price of the call option is rupees 30, it is not ES, it is RS. If the price of the call option is rupees 30, then how can an arbiter make profit is the issue. Okay, see. Now, I go to the stock exchange. I go to National Stock Exchange and visit the share segment. Visit what? Share segment. Suppose share of a company X Limited. I see the share of the company X Limited, the price. Today the X Limited share is traded. I just give a name for the company for you to understand it, easy discussion. Today in the stock market, in the stock exchange, in the share segment, X Limited share is selling at how much rupees? How much rupees here? 200 rupees. How much rupees? 200. The current spot price is 200. It is the price at which the share is being bought and sold today in the share segment. Yes or no? Next. Immediately, I click the mouse button in the next segment called as what? F&O segment. I went into the F&O segment, went into what? Option portal and then click the search. I say search what? X Limited call option. I search what? X Limited call option. There is a X Limited call option which is having a strike price of 180. Having a strike price of 180, which is maturing in what? 1 year. Trading at a premium of 30. Did you understand it or not? Now, I have two sets of data in my hand. I should analyze to check whether I have a scope for making a profit. What I am saying? This is my issue. Now, tell me, you visited what website? You visited what? NSE website. You in that first visited what place? Share trading portal. There we saw how much rupees share is trading? 200. Extreme shall say how much rupees here? 200. Okay. You just click the next mouse button for what segment? F1. You went into the F1 segment and searched for what? Options. Of which company? Extreme. We got the option quotation. Always optional, have to give the contract details. It's a contract or not? Or the deal is what? Option on extreme. What option? Call option. Is what option here? Call option. With what strike price? 200. And what the period? Sorry, 180. What strike price? 180. I wrongly saw the portal. Okay, how much here? 180. For how much maturity? 1 year. And they are quoting a premium. How much base here? 30. Now we should know whether the 30 premium is right or wrong. Yes or no? Is there any scope for making an arbitrage swap? It is a subject matter of discussion. Yes or no? No. First, I should know what is the minimum value of this call option. What is the minimum premium for this one call option? If below minimum, I have a scope for making a profit. Yes or no? Tell me, what is the formula for minimum value of the formula? We'll discuss logic later. What is the formula? Spot price minus present value of strike price. Very simple. What is spot price? 200 minus present value of 180. And strike price is going to be received only after what? 1 year. It happens only after 1 year. I have to discount it or not. So 200 minus present value of 180. When discount 180, I should discount at what percent? 10%. How many years? 1 year. Using continuous discounting. Everybody is or no? I don't multiply by 0.9091, I will not use. I'll use what? E power minus 0.10. I'll use what? Continuous discounting. We will see why it should be what? Continuous discounting after completing the futures chapter. Everybody following on? They are only discussing about mark to market and all. That will be having a logic. But always derivatives. Now, what should be the compounding discounting? Continuous compounding and continuous discounting. Otherwise, simple time value of money. Rumba simple. Why can't they supply 200 and 180? Very simple. 200 is the price today. 180 is what? Forward price. Is agreed price, forward price or not? I cannot knock off for today's price and what? Forward price. Time value of money prohibits me. Yes or no? That is why the formula is what? Spot price minus present value of strike price. More logic is there in this formula. I will be discussing after the sum has been completed. Can we start or not? No. First step is I want to find out the minimum value of the call. Next step is what? I will be comparing the minimum with what? The actual value of the call in the market and then make the appropriate strategy. Can we start or not? Let's start with the solution.